Morgan Stanley, one of the world's biggest banks, is now letting its wealthy clients buy Bitcoin. Many people are calling this a major moment, suggesting that big financial institutions are finally accepting cryptocurrency. This bank manages about $9.3 trillion for clients and has 16,000 advisors who work with some of the wealthiest people in the US. And they have finally approved their own Bitcoin product for sale after holding out for quite a long time. But here's the secret part. In the official prospectus that they filed for this new product, Morgan Stanley says some things that, well, most financial news outlets aren't reporting. While allowing its clients to buy Bitcoin, the bank is also warning that the crypto market is easily manipulated, doesn't have enough ready buyers and sellers, has big security risks that normal investments don't, and its legal status is still not clear. This is a rare example of a Wall Street firm saying publicly what they really think privately. And it shines a light on what the big beasts of traditional finance really think about Bitcoin and crypto. My name is Lewis, and over the next few minutes, I'll explain exactly what Morgan Stanley's own document admits about Bitcoin, what each warning means, and what it tells you about how one of the world's most respected wealth managers really views this market. Let's start with the facts. On April 8th of this year, Morgan Stanley launched the Morgan Stanley Bitcoin Trust, called MSBT. Notably, its fees are extremely low. It's actually lower than its competitor BlackRock's IBIT. By the end of the month, the product had already attracted about $192 million and held roughly 1,834 Bitcoin. Experts were impressed, with one ranking the launch in the top 1% of all new investment funds over the past year. Another suggests the fund was intentionally priced low to pull wealthy people interested in crypto into the Morgan Stanley family of services. This is the same bank that, back in 2017, said Bitcoin was basically worthless, and just 18 months ago, they wouldn't let their advisors suggest any digital currency product to their clients. How things have changed. For example, Merrill Lynch approved 4 Bitcoin investment funds for active selling in January. Vanguard recently dropped its longtime ban on crypto. Charles Schwab is starting to offer direct crypto trading, and Goldman Sachs filed for a complex Bitcoin product that one expert jokingly called boomer candy. Bitcoin supporters have been predicting this kind of acceptance for a decade, and on the surface, it seems to have finally happened. But there is a second, very different document tied to this announcement, and almost no one is reading it. When a bank sends out a press release, it's basically marketing. When a bank files a prospectus with the government, well, it's trying to protect itself legally. These two documents have completely opposite goals, and the truth about how institutions really feel about crypto is in the difference between what they say. Press releases are meant to sell the product to the public. Prospectuses are meant to list every possible risk the issuer can think of. If they don't list a risk and something goes wrong, they can be sued. So, when Morgan Stanley writes in the MSBT prospectus that Bitcoin is exposed to, quote, manipulative trading activity on unregulated exchanges, that it operates under, quote, unresolved legal status, and that super powerful quantum computers could someday threaten its security, well, then they just aren't trying to get attention. They're stating in a binding legal document what their lawyers believe is seriously true and must be told to protect the company from future lawsuits. The most important warning in that legal filing is the part about manipulation. They specifically mention illegal activities like wash trading, which is buying and selling to yourself to create fake activity, spoofing, which is placing large orders and then canceling them before they execute, organized trading across different exchanges, and the lack of proper supervision on overseas platforms. All of this, they say, messes with the real price of Bitcoin. In simple terms, the bank is telling its clients that the price they see for Bitcoin might not be a real reflection of how many people genuinely want to buy or sell. The structure of the crypto market lets insiders create fake demand, fake order books, and influence prices in ways that would land them in jail if they did it with US stocks. And in case you thought that this was all just theoretical, well, the FBI actually created its own fake cryptocurrency last year as part of a secret operation to catch market makers who were selling services to crypto projects to fake trading volume. By April, 10 people from different foreign companies have been charged with fraud and market manipulation. Academic studies suggest that fake transactions can make up as much as 60% of the daily volume on some unregulated exchanges. Another report found that criminal crypto addresses received at least $154 billion in 2025, a huge jump from the year before. Crypto enthusiasts have been complaining about this for years. The only thing that has changed now is that Morgan Stanley is now complaining about it too, just in the fine print that no one bothers to read. Now, let's quickly review the other warnings, because each one has a clear, real-world example that most investors should recognize. The Prospectus warns that if you lose your private keys, your crypto is gone forever. The most famous example of this is with Quadriga CX, a Canadian exchange whose CEO died in late 2018, holding the only keys to about $190 million worth of customer money stored offline. Experts estimate that about 15 to 20% of all Bitcoin ever created is permanently lost because of forgotten passwords, broken hard drives, or dead people who held their keys. New types of hacks are now directly targeting the way people try to store their own crypto safely. Liquidity risk is the warning that it becomes hard to sell your investment during times of high stress. The perfect example is FTX, which was hit with $6 billion in withdrawal requests over 3 days in November of 2022 and couldn't pay up because there was an $8 billion hole in their accounts. Prices on every exchange went crazy, and just this February, a large institutional lender froze deposits and withdrawals after losing about $75 million. Showing that this kind of problem is still happening. Regulatory risk means that the chance of negative rules coming from the government or international groups is still there. The European Union's new rules have already forced some stablecoins to be removed from exchanges across Europe. Concentration risk shows up in Bitcoin mining, where 2 big companies together control more than half of the computing power that keeps the network running. A glitch in March of this year showed that this control can actually affect the final record of transactions. Cybersecurity risk has many terrifying examples, the most eye-catching being the Bybit hack in February of 2025. North Korea's Lazarus Group compromised a third-party service and stole about $1.5 billion in ETH, the largest single theft in history. And counterparty risk is the warning that if you hold Bitcoin through a middleman, you don't actually own the Bitcoin. You own a promise from that middleman. This is what FTX and Celsius customers learned when their assets were locked up in bankruptcy court while the Bitcoin price kept going up without them. Now, if you're finding these helpful, we share these institutional reports, data, and much more besides on our free Coin Bureau Telegram channel. The link to join is down below. Right, here is the conclusions that connects all of this. The big institutions entering this market are not truly giving their approval to crypto. They are responding to their clients who want to buy it by creating products and collecting fees, while at the same time protecting themselves with legal warnings that admit the asset class has deep problems that they can't fix. Morgan Stanley's own investment team only recommends putting in a maximum of 2 to 4% of a client's total portfolio into Bitcoin. The bank has separately reported that its total Bitcoin investment across all of its holdings is only about $1.24 billion. Now, for a bank that manages trillions of dollars, that's practically nothing. BlackRock recommends 1 to 2%. Bank of America suggests a maximum of 4%. Even a huge pension fund that allocated $500 million to Bitcoin in 1 quarter sounds like a lot, until you realize that the fund's total assets are in the hundreds of billions. The message from the big institutions is not buy as much as you can. It is take a small, careful position and read the warnings very closely. So, let me tell you what you should do with all of this information. The story of big institutions adopting crypto is real, and over time it will help Bitcoin look more legitimate as an asset. But none of that institutional money fixes the structural problems Morgan Stanley just described. Those problems are part of the market itself, not the investment products being created around it. The argument for holding your own keys gets stronger, not weaker, when you realize that about 84% of all US Bitcoin ETF assets are held by a single security company. This creates a concentration risk inside the very products that were supposed to make crypto safer for you. The argument for sticking mainly to Bitcoin and a few other large cryptocurrencies gets stronger when you accept that manipulation is hardest to pull off in the markets where there is the most trading. The argument for investing a small, safe amount somewhere in that 1 to 4% range the big firms are suggesting to their wealthiest clients gets stronger when the company selling you that product is itself telling you the asset is speculative. And the argument for treating any institutional product as a wrapper that adds risk from a middleman instead of removing it, well, that becomes obvious the moment that you read what the company's own legal team had to disclose just to launch the thing. Now, Morgan Stanley opening Bitcoin to its clients is truly an important moment for the future of this asset class, and I'm not trying to convince you not to invest. But how they did it tells you the complete story. The press release sells you the product, but the prospectus tells you the truth about what you are buying. One of the biggest wealth managers on earth just told its clients in writing that this market is fundamentally flawed, and they are selling the product anyway. Whether you see this as the big bullish moment finally arriving, or as proof that the serious problems are worse than the biggest supporters admit, the legal document itself is the most useful thing Wall Street has said about crypto in years. Read it, take the warnings as seriously as you take the exciting headlines, and choose your investment size accordingly. I'm Lewis, thank you for watching, and I'll see you next time.